Hello everybody. In this video, we're gonna talk about the depreciation of non-current assets. First of all, we will go through the definition of depreciation and why we need to apply this concept on business. And then we will summarize three of the most common methods of depreciation, which are single line depreciation, double line depreciation, and the unit of production depreciation. Now, depreciation is a means to allocate the cost of the original cost of the asset over a number of accounting periods, because that asset is used up in the operations of the entity over many accounting periods. A portion of the asset cost should be subtracted from the income that was generated through the use of the assets. In financial accounting, depreciation is an application of the matching concept. If entire cost of that asset is recorded in first period only, it would cause low profit or probably a loss for that period. It would be bad if shareholders read that period report. In financial statements, accumulated depreciation account contains the sum total of all the depreciation expense that has been charged against the asset over its life. Up to the balance sheet date, accumulated depreciation account is a contra account, which means that it appears on the balance sheet as a deduction from the original purchase price of an asset. Let's look at an example here. The company purchased a machine at a cost of $80,000. After 1 year, depreciation for the machines is $18,750. Now in this table, the accumulated depreciation was deducted from the original cost of the machine, and the carrying amount of the machine, which is the difference between the original cost and accumulated depreciation. In this case, it is now $61,250. Let's move to the depreciation methods. As mentioned before, there are three most common methods of calculating depreciation. Let's assume that we have a machine. Actually, the only company have a machine. They purchased that at the beginning of 2006 as a cost of $80,000, and the company expected to use the machine in 4 years, and the salvage value, which the value left after being used of the machine, will be $7,000. And one assumption is, before expired, the machines will produce 500 units. Okay, the first method of calculating depreciation is called single line depreciation, and we have a formula here. The depreciation for each year can be calculated by using the original cost minus the estimated salvage value, and then the result will be divided by estimated useful life. This means the number of years. In this example, we calculate that in 4 years of the machines, and each year the depreciation will be $18,250. This depreciation expense will be equal with each year during the useful life of that machine.
So now I'm gonna talk about the other method to calculate the depreciation. Second one we call that is the double life depreciation. Because we have the useful life of the machine is 4 years, so the straight line rate will be 25% for each year. This led to the double line rate will be 50%. First of all, we will need to put the 0.5 rate in the factor column. And then at the beginning of the year 1, the value of the machine now is 80,000. So at the end of year 1, the depreciation expense will be 40,000. And it will add into the accumulated depreciation for the first year. So at the end of the year 1, the net book value of the machine will be 40,000 remain when you subtract with the depreciation expense. By using the same method, at the beginning of year 2, the value of this machine is 40,000 at the beginning, and next, the depreciation of that year will be 50% of the beginning value, so it should be around 20,000, and add up to the accumulated depreciation will cost you 6,000 already. This will show in the value at the end of the year 2 will be 20,000 remain. The same method will be applied into year 3. In the last year, we will start with the remaining value of the machine at the end of year 3. This is 10,000 here. And then the remaining value at the end of year 4 will be the salvage value of that machine, which is 7,000. So now we can calculate that the depreciation for that year is 3,000 and end up in 73,000 for the accumulated depreciation. Next we're going to talk about the last method, the unit of production depreciation. By using this method, we will need to calculate the depreciation that costs when the machine produces 1 unit of product. And to calculate it, we will need to use the cost of that machine at the beginning minus the estimate value of it, and then divide by the estimate total unit that machine can produce during its useful life. And by this calculation, we will have the depreciation for 1 unit is $146. Next, we're going to put it in the table. And this time we don't have the factor column, we use the unit that the machine can produce in 1 year. So at the beginning of year 1, the value of machine is 80,000. The unit that this machine can produce in year 1 is 120, so we get 120 multiplied by 146, and we got the result is more than 17,000 for year 1. And by doing the same method, we have in the second year another 120 units was produced, so the net book value of this machine at the end of the year 2 is about 44,000. The same method can be replayed in the next year until the last year of its useful life. So this is the last method of the depreciation calculation. Thank you for your time.